Welcome to this in-depth exploration of discounted cash flow, or DCF, valuation. This fundamental financial modeling technique is crucial for anyone looking to understand the true worth of an investment. We will break down its core principles and practical application. At its heart, DCF is a method used to estimate the intrinsic value of an investment. This could be an entire company, a specific project, or even a single asset. It provides a robust framework for making informed financial decisions. The core principle behind DCF is straightforward yet powerful. It posits that the value of any asset today is simply the present value of all the cash it is expected to generate in the future. This concept underpins much of modern finance. Ultimately, DCF seeks to answer a fundamental question: how much is this investment worth today, considering the cash it's expected to generate in the future? By answering this, we can determine if an investment is undervalued or overvalued. Building a DCF model involves several distinct, yet interconnected, steps. Each component plays a vital role in arriving at a reliable valuation. Let's delve into these key stages. The first critical step is to project the future cash flows of the investment. This typically involves forecasting over a defined period, often 5 to 10 years, depending on the stability and maturity of the business. During this forecast period, we meticulously project key financial items. These include revenue growth, operating expenses, and necessary capital expenditures. Accurate forecasting here is paramount to the model's reliability. The ultimate goal of these projections is the calculation of free cash flow, or FCF. FCF is the key input for the DCF model, representing the cash truly available to all capital providers. Free cash flow represents the cash generated by a company's operations after accounting for operating expenses and investments in its assets. It is the cash that can be distributed to shareholders and debt holders without impairing the business. Once we have projected these future cash flows, the next step is to discount them. The purpose of discounting is to bring these future cash flows back to their present value. $1 today is worth more than $1 tomorrow due to inflation and opportunity cost. The discount rate is a critical element in this process. It reflects two important factors: the time value of money and the risk associated with the investment. A higher risk generally demands a higher discount rate. Typically, the weighted average cost of capital, or WACC, is used as the discount rate. WACC represents the average rate of return a company expects to pay to all its security holders, including both debt and equity. WACC considers the cost of both debt and equity financing, weighted by their respective proportions in the company's capital structure. It is a blended rate that reflects the overall cost of funding the business. It is important to remember that a higher discount rate is used for riskier investments. This reflects the higher return investors demand to compensate them for taking on greater uncertainty. Conversely, less risky investments will have a lower discount rate. Beyond the explicit forecast period, we need to account for the value the investment generates indefinitely. This is captured by the terminal value, which represents the value of the investment beyond the explicit forecast period. There are two primary methods for estimating terminal value. The first is the perpetuity growth model, which assumes a constant, stable growth rate for cash flows into perpetuity after the forecast period. This growth rate is typically modest, reflecting long-term economic growth. The second method is the exit multiple method. This approach applies a multiple, such as an enterprise value to EBITDA multiple, to a financial metric at the end of the forecast period. This multiple is often derived from comparable company transactions. Regardless of the method chosen, the calculated terminal value is also a future value. Therefore, it must also be discounted back to the present day using the same discount rate applied to the explicit forecast period cash flows. With all future cash flows and the terminal value discounted, we can now begin to assemble the total value. We start by summing the present values of all the projected free cash flows from the explicit forecast period. This sum represents the present value of the company's operating assets. To this sum, we then add the present value of the terminal value. This combined figure gives us the total enterprise value of the company, which represents the value of the entire business to all its capital providers. From this enterprise value, we must then adjust for net debt. Net debt is calculated as total debt minus cash and cash equivalents. This adjustment is crucial because enterprise value includes the value attributable to debt holders, while we are seeking equity value. Subtracting net debt from the enterprise value yields the estimated equity value. This figure represents the total value of the company that belongs solely to its shareholders. The final step in the DCF process is to determine the intrinsic value per share. This is calculated by simply dividing the estimated equity value by the total number of outstanding shares. This per share value provides a direct comparison point for the current market price of the stock. If the intrinsic value per share is higher than the market price, the stock may be considered undervalued. While DCF is a powerful tool, it is not without its challenges and limitations. Understanding these is crucial for its effective application and interpretation. One of the most significant aspects of DCF is its sensitivity to assumptions. The accuracy of the entire model depends heavily on the quality and realism of the financial projections made for revenue, expenses, and capital expenditures. Similarly, the chosen discount rate has a profound impact on the final valuation. Even small changes in the WACC can lead to substantial differences in the estimated intrinsic value. This highlights the importance of careful discount rate estimation. Furthermore, the terminal value calculation is often a major driver of the overall valuation. Its reliance on either a perpetual growth rate or an exit multiple introduces significant sensitivity and potential for error. Given these sensitivities, it is crucial to conduct thorough research when building a DCF model. This includes deep dives into industry trends, competitive landscapes, and the company's specific strategic initiatives. It is also essential to understand the underlying business in great detail. A strong qualitative understanding of the company's operations, management, and competitive advantages will inform more realistic quantitative projections. To mitigate the impact of uncertain assumptions, it is vital to perform sensitivity analysis. This involves testing how the valuation changes under different scenarios for key inputs like growth rates, margins, and the discount rate. This provides a range of possible values rather than a single point estimate. Despite its inherent limitations and the need for careful judgment, DCF remains a cornerstone of financial analysis. It provides a structured, logical framework for thinking about value creation. DCF forces analysts to think critically about a company's future prospects and the risks involved. It moves beyond simple multiples and delves into the fundamental drivers of value. Ultimately, DCF provides a robust framework for making informed investment decisions. It helps investors and analysts determine whether an asset is truly worth its asking price, based on its ability to generate future cash flows.